So now we move on to our first panel discussion of the morning, entitled Uncertainty in the Geo-Economic Environment, Meeting the Challenge. It gives me great pleasure to welcome Lisa D. Cook, member of the Board of Governors of the Federal Reserve System, who will deliver a keynote address before we introduce our next panel. Dr. Cook took office as a member of the Board of Governors of the Federal Reserve System on the 23rd of May 2022. Prior to her appointment to the board, Dr. Cook was a professor of economics and international relations at Michigan State University. We are delighted to have her here with us today. Thank you.
Thank you for that kind introduction and for the invitation to speak at the Central Bank of Ireland. I am delighted to be with you today to discuss financial stability. My own work as an academic economist has frequently reinforced the importance of financial stability in the United States and abroad. Early in my career, I examined the impact of underdevelopment in the Russian banking system on growth in post-Soviet Russia and the instability that can occur in a poorly regulated financial system. Years later, as an economist on the Council of Economic Advisors in the White House, I saw how weaknesses in the financial system contributed to instability in the euro area. These formative experiences shaped my view that the Federal Reserve's work on financial stability is critical to the well-being of households, businesses, and the broader economy. This is one reason I especially value the opportunity to serve on the board's Committee on Financial Stability. I will focus my remarks on my assessment of financial stability risks based on the Federal Reserve's framework for monitoring vulnerabilities in the financial system. In my view, our financial system is substantially more resilient than it was in the mid-2000s, reflecting progress by regulators and the private sector and boosting resilience. Nonetheless, we cannot be complacent, and I see some important risks. Achieving the Federal Reserve's dual mandate of maximum employment and stable prices depends on a stable financial system. We all saw how the Great Financial Crisis triggered the Great Recession and brought misery to countless millions who lost their jobs, homes, or investments. A stable financial system provides households, communities, and businesses with the financing they need to invest, grow, and participate in a well-functioning economy, even when hit by adverse shocks or events. Consistent with this view of financial stability, our framework for how we think about this goal is laid out in our Financial Stability Report, or FSR, which was just released in October, distinguishes between shocks to and vulnerabilities of the financial system. Importantly, and as we know, we cannot predict exogenous shocks, which are, by definition, the surprise events that will hit the financial system and economy. By contrast, vulnerabilities, the aspects of the financial system that would exacerbate stress, tend to build up over time and can be identified, assessed, and monitored. In the example of the global financial crisis, although it was widely recognized that housing valuations were high, the magnitude of the ensuing price drop was unexpected or a shock. That shock was amplified by vulnerabilities that had built up within the financial system over time, including weak bank capital, excessive household debt, lax lending standards, and fragile short-term wholesale funding. One hard-learned lesson of the crisis is that the Fed and other regulators must watch closely for vulnerabilities that may build up within the financial system. Based on this experience, other historical episodes, and academic research, in the board's FSR and other work, we focus on assessing vulnerabilities across four broad categories: asset valuations, borrowing by businesses and households, financial sector leverage, and funding risks. Through contacts with market participants and experts, we also consider near-term risks, that, if they were to come to pass, could interact with these vulnerabilities. One key set of vulnerabilities stems from valuation pressure. The willingness of investors to take on risks is closely related to the economic and financial cycle. When their risk appetite drives prices higher relative to economic fundamentals, there may be greater risk of outsized drops in prices that can be destabilizing. The Fed looks at a broad range of asset markets, including equities, treasury securities, corporate bonds, loans, and real estate. This table from our FSR shows the sizes of the asset markets discussed in this section as of Q2, the most recent data available. The largest asset markets are those for residential real estate at $56 trillion, equities, treasury securities, and commercial real estate at $24 trillion. This year, asset valuations have generally risen notably above their historical levels. In particular, prices of residential and commercial properties remain above levels historically associated with fundamentals. House prices relative to rents are near all-time highs. Further, prices have started increasing again in recent months after falling for more than a year. Commercial property prices also remain high relative to rental income. I am watching closely the extent to which post-pandemic supply and demand patterns normalize. Demand in the office sector has remained weak, particularly in central business districts and coastal cities, with vacancy rates increasing further and rent growth declining. Finally, average delinquency rates for commercial mortgage-backed securities have moved up recently as office and retail loan performance has deteriorated. If delinquency rates generate selling pressure or increase notably further and result in forced sales of properties, then CRE prices could decline sharply. Another notable market development has been the significant increase in longer-term bond yields since June. Decompositions between changes in expected rates and term premia depend on the specific models and assumptions used. But I would say that an expectation of higher near-term policy rates does not appear to be causing the increase in longer-term rates. Valuation pressures are especially concerning if they are associated with excessive borrowing. If households or businesses borrow too much, they may be unable to service debt or could find themselves underwater if assets decline in value. Such stress can propagate through the financial system, causing funding shortages that curtail credit and hamper economic activity. Of course, it is very difficult to tell in real time whether households and businesses are in fact borrowing too much, so we rely on a range of benchmarks. Currently, business debt is at historically high levels relative to such benchmarks as gross domestic product or GDP, or business assets, although those ratios are significantly lower than the record highs reached at the onset of the pandemic. However, measures of the ability of firms to service their debt remain strong overall, supported by resilient corporate profits and limited effects to date from higher interest rates. The pass-through of higher interest rates into debt servicing costs appear to be muted by the large share of long-term fixed-rate liabilities. However, I note that for risky borrowers or those with high yield or unrated debt, the ability to service their debt burdens has started to show signs of weakness, as would be expected in a rising interest rate environment, and could become further strained if corporate earnings fall due to a sharper than expected slowdown in economic activity. The household sector, taken as a whole, looks quite resilient. Household debt, including home mortgages, auto and student loans, and credit cards, remains at modest levels relative to GDP, and most of that debt is owed by households with strong credit histories and considerable home equity. Of course, we are seeing emerging signs of stress for households with lower credit scores, and individual borrowers may struggle with debt burdens in the face of economic hardship. Now we turn to financial sector leverage. As I mentioned earlier, we pay careful attention to our financial system's ability to support the activities of businesses and households. When financial institutions are overly indebted, adverse shocks can cause them to retrench more than they would otherwise, resulting in greater declines in economic activity. In extreme circumstances, such effects can lead to credit crunches and widespread economic dislocation. Similarly, some institutions may be forced to rapidly deleverage, stressing markets and forcing other institutions to also pull back. The United States has a large and vibrant financial system, so it is important to assess leverage across a broad array of non-banks and banks of all sizes that provide credit to our economy. Starting with banks, the banking sector remains sound and resilient overall. Most banks continue to report solid capital levels well above regulatory requirements. The rise in interest rates over the past 2 years has contributed to robust bank profitability, as banks earned higher interest income on floating rate loans while interest expense on many deposits remained well below market rates. At the same time, higher long-term interest rates also substantially affected the fair value of banks' holdings of fixed-rate assets. As we saw earlier this year, fair value losses on bank balance sheets, when combined with poor liquidity and interest rate risk management, could leave banks exposed to additional risk. While acute stress has abated, I continue to monitor the situation closely. Some non-banks are quite leveraged. For example, available data suggests that hedge fund leverage remains elevated, especially for the largest hedge funds. It is important to better understand how their leveraged activities could impact the functioning of underlying markets. Looking at funding, many financial institutions raise funds from the public with a commitment to return their money on short notice. But those institutions then invest much of those funds in assets that are hard to sell quickly or have a long maturity. This liquidity and maturity transformation can create strains across markets or institutions, particularly in the absence of a lender of last resort, such as the Fed's discount window for commercial banks. In the banking industry, the deposit volatility that we saw earlier this year has abated. Yet some banks have had to turn to higher cost funding sources to make up for lost deposits and face reduced market values for investment securities. Outside of banking, we also monitor a wide range of non-bank financial institutions, or NBFIs, such as money market funds, open-end funds, insurers, central counterparties, and digital assets. Many of their activities give rise to a liquidity mismatch that could amplify market stress. They have daily or frequent redemption possibilities on the liability side, while holding less liquid assets. I think the Securities and Exchange Commission's recent reform on money market funds and proposal for open-end funds are encouraging steps towards mitigating funding risks arising from non-banks. Let me illustrate how these vulnerabilities factor into my views on the resilience of the financial system. I will walk through how potential near-term risks could interact with current conditions in the United States. I will cover both domestic and international risk in a way that is closely aligned with the discussion in the FSR. In recent outreach, as summarized in this figure from the FSR, contacts were particularly focused on the persistent inflationary pressure leading to further monetary tightening, the potential for significant losses on CRE and residential real estate, the reemergence of banking sector stress, and market liquidity strains and volatility. As I said earlier, the banking sector has stabilized since the period of acute stress earlier this year, and the system as a whole has ample capital and liquidity to withstand shocks. I continue to monitor the system for signs of renewed stress. I also support seeking public comment on federal banking agencies' Basel III endgame proposal on bank capital requirements. In addition, MBFIs have become an integral part of the financial system and are increasingly interconnected with the banking sector. It is crucial for relevant authorities to implement stronger oversight and appropriate prudential requirements for non-banks. This is especially important amid concerns that proposed higher capital requirements for large banks could cause some bank activities to migrate to the more lightly regulated NBFIs. It would be the most effective and balanced way to enhance the stability of the entire financial system. Internationally, inflationary pressure persists in advanced foreign economies and could pose risks to the global financial system. Energy prices have increased notably in recent months, potentially forcing businesses to pass on renewed cost pressures to customers. An unexpected increase in policy rates abroad could lead to heightened volatility in financial markets, strains in market liquidity, and an adjustment in asset prices. Higher interest rates, particularly if they persisted, could be a binding constraint on the debt servicing capacity of foreign households, businesses, and governments. Taken together, these factors could lead to pronounced losses among global financial intermediaries and a consequent reduction in the supply of credit. In China, a further slowdown in economic growth could worsen financial stress. Many Chinese firms, especially in the property sector, are struggling to service very high debt burdens. Local governments are also facing increasing financial strains. Stress originating in China could spill over to other emerging markets, or EMEs, especially those highly dependent on trade with China or on credit provided by Chinese entities. The spillovers could trigger significant capital outflows from EMEs, which may already be more susceptible to external shocks given generally heightened debt levels. Given the size of its economy and financial system, financial stress in China could be propagated to global markets more broadly through disruptions to economic activity, deterioration of risk sentiment, and a sharp appreciation of the dollar. Last but not least, a worsening of global political tensions, including those involving Russia, the Middle East, and China, could lead to broad negative spillovers to global markets. Russia's ongoing war with Ukraine continues to weigh on many economies in a variety of ways, including sustained disruptions to regional trade and food, energy, and other commodities. The conflict in the Middle East could generate further risks to energy and financial markets, as well as a worsening of global humanitarian and migration challenges. More broadly, escalation of geopolitical tensions could lead to lower economic activity and increased fragmentation of global trade flows and financial intermediation, raising financing and production costs and contributing to more sustained supply chain challenges and inflationary pressure. The global financial system could be affected by pullback from risk-taking, declines in asset prices, and losses for exposed businesses and investors. I conclude by saying that we must remain vigilant to potential shocks that could exacerbate vulnerabilities in the global financial system. Thank you for inviting me to speak here. I look forward to participating on the panel.
Thank you, Dr. Cook. Building on Dr. Cook's speech, we will now have our first panel discussion, and I would like to invite the participants to come to the stage. Vasileios Madouros, Deputy Governor, Monetary and Financial Stability, Central Bank of Ireland, will chair the panel. And in addition to Lisa D. Cook, our panellists include Maria Demertzis, Senior Fellow Bruegel and Professor of Economic Policy, European University Institute Florence, Cornelia Holthausen, Director General, Macroprudential Policy and Financial Stability at the European Central Bank, and Stephen Kinsella, Professor of Economics, University of Limerick.
Perfect. Okay, thanks so much, Denise, for the introductions of our panel, and thanks very much, of course, for the organization of this whole conference. Good morning, everyone, also from me, from those who are here and those who are joining us online. Let me start by extending a very warm welcome to our panel members. Really delighted to have you all here. Couldn't think of a better panel for the session that we're about to have. Thank you so much, Lisa, for the very insightful introductory remarks. I think they tee up our panel really, really well. The topic of this panel is about uncertainty in the geo-economic environment and meeting the challenge. And as we've discussed already, I don't think anyone would disagree that the degree of uncertainty in the operating environment is highly unusual. I mean, we've had a global pandemic, war in Europe, an energy crisis, inflation reaching levels we haven't seen in decades, and of course, most recently, the tragic events in the Middle East. And setting a course through this fog of uncertainty in the pursuit of good outcomes for society is a key challenge for all of us, right? Whether we're policymakers or in the financial sector or businesses. So our plan for today is to try and take a more macro perspective on these issues and hopefully set the scene for the rest of the conference today. And time permitting, because this is a big topic, so I don't know if we'll be able to get to all of it, we plan on covering 3 themes. So the first one is the macro-financial environment, and as we've heard already this morning, this abrupt shift from this period of low inflation, low interest rates to above target inflation and higher interest rates to ensure inflation goes back to target, which is still ongoing, and it will take time to feed through to the economy and the financial system. The second one is around fragmentation and the risks of fragmentation of the global economy and the role of geopolitics. Again, we've heard a lot about this this morning, and we are seeing it already impacting economies. We talk to businesses as well all the time, and they tell us how they're trying to adjust to these changes and developments. But of course, it's the risk of further fragmentation can have global risks, and for us in Ireland, as a small but highly globalized economy, it's particularly relevant. And the third one is on the evolving financial system, and again, we touched on a little bit this morning in terms of different dimensions. Some of it's about non-bank financial intermediation, some of it's about innovation in the financial system driven by technology. And again, of course, for us in Ireland, the shape of the financial sector here has changed and is evolving. It's become increasingly complex, internationally oriented, and growing. So a lot of big issues. An hour, so we'll try as much as we can. So why don't I stop there? Maybe we kick off the discussion. And Lisa, maybe I can start with you, just picking up the baton from your remarks. You talked about how the financial system has been managing interest rates. Of course, most recently we've also seen this big increase in long-term interest rates, as you mentioned, not necessarily driven by expectations of policy rates. So how much strain do you see these developments putting on the financial system? What's your assessment of the resilience of the financial system to these developments in interest rates?
That's a good question. What we've seen is that firms, households, markets, banks, and other participants in the economy have proven to be fairly resilient. Certainly, we know that partly this is due with respect to businesses and households. They're relatively strong balance sheets, so they've weathered this storm. But we've all seen the U.S. and global economies, the global economy, have seen they've experienced inflation, and businesses, households, and firms are banks are adjusting to higher rates. So we have to be attentive to what could happen as a result of these higher interest rates. And what we also see is that we've experienced these geopolitical tensions that you're talking about, and certainly this could make, any shock could make the situation worse that we're already in, and could be destabilizing. Could be destabilizing to commodity markets, as I mentioned, and could be destabilizing to the system of credit. So I think that we are watching and waiting. We're being vigilant, and that's what we do. We identify, assess, and monitor these vulnerabilities that I mentioned in my speech.
Great, thanks. And maybe just one more to link this session to the previous one as well. I mean, you outlined in your remarks a range of potential vulnerabilities that you're monitoring. And then previously, in the previous session, in Andrew's remarks, we're talking about international cooperation amongst regulators. So from your perspective, what are some of the areas where we can cooperate more closely to safeguard resilience and make sure that the financial system globally is in a better position to serve businesses and households in good times and in bad?
I think the biggest area of cooperation now would be with NBFIs, with non-big financial institutions. As was said earlier, they're growing tremendously. Their importance has grown tremendously, and we don't have much sight into them, as we're not in charge of regulating them. So I think we have to gain more information, and we have to be more vigilant in monitoring not just their activities, but the effect of their activities on the rest of the financial system.
Perfect, and I'm sure we'll come back to this as we talk about the evolving financial system. So maybe Cornelia, could turn to you. Maybe you can give us a euro area perspective. Of course, the ECB monitors and conducts a financial stability assessment regularly, and the risks facing the financial system and the resilience of the financial system. So in this environment, what is your assessment of some of the, how the euro area financial system has responded and coped to the big shift in the environment that we've seen, and high inflation and interest rates, and what are some of the vulnerabilities on the horizon that you're looking at?
No, thank you, Vas. I'd be happy to speak about that. So, I mean, so far the financial sector in Europe has held up remarkably well, I think. If you consider all the shocks that have occurred, as you mentioned before, I mean, if you had told me 4 years ago that we would have all of this, I would have said, okay, well, we will live on the moon by that time, so it was completely out of the question. I think just earlier last year, we did an internal stress test about rising interest rates, and the adverse scenario was a 200 basis point increase. So, and now we are at more than double than that, so there you see how good we are in predicting things at central banks. No, but the banking sector has a very high shock absorption capacity right now. That we have a stringent regulatory and supervisory action, so banks really have solid fundamentals, and we saw that also earlier this year in March when we had the tensions in the US banking sector and in Credit Suisse. So European banks, fingers crossed, they have held up really well and were able to weather that. And yeah, I think there are several reasons for that. Let's not forget there were lots of governmental and other support measures over the past few years related to the pandemic. So both on the fiscal side and also the central bank support has, of course, been remarkable, and that helped. But apart from that, European banks do have very solid capital and liquidity positions, and I think that was particularly helpful earlier this year. But having said that, I think we are in a very fragile situation. There's a lot of uncertainties, as you mentioned, and others, on the macro-financial outlook. We have the geopolitical tensions arising in several areas of the world, and that gives a lot of uncertainty, and it's also not an environment that's conducive to investment and optimism. So let's see how these effects play out. And then, of course, we still have to see the long-term effects of the rising interest rates. I mean, we know that monetary policy functions with a lag, and we still have to see how our non-financial sector in particular is able to cope with this environment. So there are lots of different risks. I mean, on the cost of financing for banks, for instance, I mean, deposit rates have not adjusted yet a lot in the euro area. So the 4% or so increase in interest rates that we saw has only had like really a very small fraction impact on deposit rates, and there will be a time when this will increase, no? But so banks will have to face higher refinancing costs once that happens. And another effect is then via banks' investments, so the loans by the non-financial sector, of course, the higher interest rates and the inflation that is now luckily coming down, but it both weighs on the debt servicing capacity of borrowers. So that's, the credit risk inherent to that is going to play out, but we don't know how much yet.
Thank you very much. I mean, so we've talked a little bit this morning about monetary policy, and we're talking about financial sector issues as well, of course. But when you think about macro resilience and the very uncertain environment that we're facing, there are other levers. So maybe Maria could give us a perspective on broader macro stabilization policies. Fiscal policy, of course, has a role to play, potentially structural policies to enhance economic resilience in the EU. So what is your take on the broader macro stabilization framework in the EU in the context of the environment that we are facing at the moment?
Yeah, so first of all, thank you very much for the invitation, Governor, Deputy Governor. Thank you for inviting me to this fascinating event. I wanted to perhaps comment on the title, I see it in front of me on the screen, on Achieving Good Outcomes in an Uncertain World. So the emphasis on the good outcomes, not on perfect outcomes. And I think as a way of thinking of how to navigate the uncertainty that we are facing, and we all agree this is immeasurable uncertainty. So, the policy decisions that we have to make cannot be based on the idea of achieving perfect outcomes, because there is a trade-off here. Perfect outcomes are for very specific circumstances, and we need to prepare for many alternative circumstances, given that we don't know what's going to happen in the next 4 years. So, policy decision, not only on the monetary side, the fiscal side, general economic policy decision, needs to allow for the fact that we need to be prepared for a possibility of many different things happening, and therefore we cannot really aim for perfect outcomes. We need to aim for good enough outcomes. And the question is, how do you calibrate good enough outcomes? That's, of course, for the policy. Now, on the macro side, so of course, I think on the inflation side, it's a very difficult position right now. The inflation side, inflation pressures have not gone down. They are all the result of what we now call the second round effect. So the policy can actually do something. We've heard this morning policy, it will be restrictive for some time. And therefore, on that side, the help that can come from monetary policy is very little in terms of sustaining, the growth in the economy. On the risks, they're on the downside. All the risks are on the downside, given, of course, all the geopolitical tensions that are arising. And if we haven't seen increase in energy prices, but we are monitoring that very closely, because if that were to come back, then we are, back into, will bring us back anything between 15 and 20 months. So it's really the fiscal side. Now, and here I can only really comment on the euro area, so I won't comment on the US or on the UK. But on the euro area, there's a number of interesting things that are relevant in my view. The 1st of January, we will be coming back into a fiscal framework, into a way of coordinating fiscal policy in the EU. And I'll say we will come back to a fiscal framework, because I'm not sure which fiscal framework we'll come back to. I'm hoping we will come back to the one that is being discussed right now, but it's the possibility of that not happening is not zero. And if we don't come back to that, we'll come back to the old one. In any case, fiscal policy will have to be restricted as we come back at a time where growth is really very flat. And in some countries, it can be even less than that. So again, we are coming into a more restrictive fiscal framework at the time when the outlook is less than perfect. Next to that, and here I think is in my view, where we need to think a little bit more strategically in the EU, is this idea of what are we going to do about strategically investing in the future, given all of the risks that we see around us, including the geopolitical risks. Europe really needs to think about investing strategically on certain things. We are starting from a position where a number of countries in the EU are very highly indebted, which means that the space that they have to actually invest in the long run is much smaller than others, and yet the need for financing certain things and dealing with the resilience, dealing with strategic autonomy, dealing with all these issues that are of pivotal importance to the EU are there. And here I really, first of all, I think politicians really need to get on with deciding on the fiscal framework, because the new fiscal framework, the way it's designed, is better than the old one. That will be helpful. And then the other issue on the strategic investments will require some decisions on what are truly European public goods, finance those, and finding good ways of financing those by pooling resources that are going to necessarily do that. So, I think it's absolutely important that on certain things we advance at a minimum speed that is common across Europe. And here I'm thinking climate as the prime example of a European, arguably global public good. But unless we all advance at a minimum level that is the same, we won't meet the targets on climate. So here I think the strategic investments on climate are very important. So that, what I think, is the way that I would describe the immediate future thing is getting into the fiscal framework and then finding ways of pooling resources to finance what is absolutely strategic for the future of the EU.
Thanks very much. And I think this really speaks to the interaction between policies as well. We have monetary policy, of course, to fight inflation, macroprudential policy or financial sector policies to ensure the financial system doesn't amplify the shocks and actually allows monetary policy to do its job. But then we also have to think about fiscal policy and structural policy for the future, and we might come back to some of these issues as part of the geo-economic fragmentation theme as well. But actually, Stephen, I think that, that from kind of an Irish perspective, if we look a little bit beyond the near term and the macro stabilization issues in the near term, which of course is crucial, but a bit more into the medium term, what are some of the big issues for us from a policy perspective, from a structural policy perspective, or industrial policy, I guess? Yeah.
Good. Thank you very much, and thank you very much for the invitation to speak, and to the audience, for the Masters in Economics students at UL watching online. This is on the test. let there be no doubt. If you're worried, you'll have a good sense of what the assignment is when I get back. I want to talk a little bit about structural policies, because Ireland does a lot of its best work when thinking about structural policies. I think one of the caricatures of our policy system is that it's inherently reactive, which does well in a crisis. Actually, we've done pretty well with some structural policies in the past. The first to really think about is skills. So I'd urge everybody in this room to read the OECD's report on skills in Ireland in the last while. It's a 240-page report, but it basically boils down to the fact that we need to be educating people for a much higher skill level. And this is already in a country where most people under 40 already have an undergraduate degree. The students that are watching online, they have been using AI since day one, since it came out in November. We are educating them to be AI first. So the idea of like, are they using it? That's over, right? Every worker is going to be using AI. And as Governor Bailey said, the question is how you're going to use it, not if you're going to use it. Thinking carefully about what the labor market matching models are under conditions of vastly accelerated technological progress is a real challenge for labor economists. It also obviously has a real impact on what central banks do, because we know, as Governor McClue said, that we need to have a much stronger focus on the supply side. On infrastructure, I'll make 3 points. The housing one is the most obvious. I chaired a management meeting this morning. Student housing, student accommodation, student homelessness is an issue in this, one of the wealthiest, most developed economies in the world. That's a vast infrastructural challenge I have to deal with on a daily basis. We just need to get under that. Second is about renewables. So particularly to the point about climate fiscal challenges, we're moving into a situation where we're going to have a climate fiscal state. You saw the flooding down in Cork recently. The government had to move almost immediately to do something about it. That's going to become the norm. The question is, how do we do that in a sustained and framework-based manner? And how do we invest in renewables? The country uses 5 gigawatts of energy. There's 75 gigawatts off the west coast of Ireland. Why aren't we acting on this? This matters. The final point is about envisioning a future where we have energy abundance on this island. That's an extraordinary thing to think about, Ireland as an energy exporter. The final point is about look-forward functions. One of the things I'm thankful for as a consumer of the central bank's research, and it's like I was always open on my browser, is looking at the research as a look-forward function. What is happening in the non-bank financial sector, particularly calling out the work of Brian Gold and Eduardo McKee, the work they've done, and many others, because I think it's very important. One of the things that we're going to struggle with in the future is the coherence between policy sets. So industrial policy, climate policy. Sometimes they're going to reinforce each other. Sometimes they're going to fight against each other. Thinking very, very clearly about how that works will matter massively. Because, as I said, what we're going to look forward to is the emergence of a climate fiscal state. We don't have a choice in this. It's already baked in, even if we stop tomorrow. And so thinking carefully about these things that we can't avoid means that when they arise, we have, to your point, not the best option, but a good enough option that we muddle through and we mitigate the downside for households and firms.
That's great, thanks. I mean, this kind of time horizon question, I think, is really interesting from a policy perspective as well, because you have near-term macro stabilization policy on the one hand, and making sure that inflation returns back to target, but then also making the space to invest for the future, for the challenges of the future. So we might come back to that as well. But why don't we move to our second theme, and then actually, just so you know, we'll open it up for questions, because we do want to make it interactive, whether here or online. So if you want to put questions on the Q&A. The second theme is about geo-economic tensions, fragmentation. We have seen this increased restrictions on trade flows and on direct investment flows. We've seen increased policies by governments to try and attract investment, the so-called reshoring or friendshoring policies. This can, of course, entail risks. It's basically also incorporating broader objectives into economic policy. So I think that's an interesting dimension. But maybe, Lisa, starting with you, how do you see international economic and financial conditions, the potential interaction with some of these geopolitical risks?
So, international and economic and financial developments are really important because they affect our economic outlook. We have a dual mandate, but clearly what happens in the rest of the world affects the U.S. And right now, economic growth is pretty subdued among our major trading partners. So in Europe, growth is subdued, and China, the same is true. And while there has been growth in the most recent period, there has been a return to pre-pandemic levels. So we take all of this into account. So we are not only watching subdued growth, we're watching the geopolitical tensions that we're all talking about, and that could change the outlook both in the United States and in the global economy. So we're very attuned to that.
Very good. And maybe just if you think about, Maria, in terms of an EU perspective, we are a particularly open economy in the EU. And this increasing focus of economic policy design that reflects broader objectives. What's your assessment of how Europe is positioning itself in this environment, and what are some of the trade-offs that might be associated with economic policy being increasingly driven by, say, foreign policy objectives or security objectives?
Yeah, economic statecraft. Yeah. So maybe I can start with the term strategic autonomy that we have heard a lot about that. I personally am not a big fan of the term, and the reason why I'm not a big fan is because it invokes protectionism, and I'll come back to that. I much prefer the term that is used now, which is that of de-risking. I like this term because, I mean, I always think if you've ever been to a management course, so the first thing that you are taught is business continuity. How do you make sure that you can deliver on what you have to deliver? And de-risking is part of that. And I think it's good because what we're trying to do is we're trying to solidify our economic production, but without necessarily invoking political issues. So that's why I prefer the issue of de-risking as a strategy for resilience rather than the issue of strategic autonomy. Right. In terms of the trade-off, they're everywhere, right? I mean, it is the economic optimization versus the economic security. This is really the trade-off. And you see it on the length of the supply chains. We've heard it also in this morning. We see it on the criticality of certain sectors, and particularly on the rare materials, which are so essential for all the economy, including the green transition. And of course, we see the trade-offs also on the issue of energy diversification, where we have very abruptly had to change our energy dependencies. We are creating new energy dependencies. Let's be clear about this. It's important that diversification is at the core of what we're doing, or we are risking similar issues from a different nature, but equally destructive in terms of our economy. So the issue of economic statecraft taking over, I think what you mentioned, taking over actually economic design is really the issue here. In the EU, there are a number of challenges here. The first one is that we don't have a common foreign policy. We don't have one. And therefore, when you see policies of economic statecraft, they are by far ad hoc. They're far in between and ad hoc. We managed to find ways to respond to the Russian aggression in Ukraine, but that was a very big shock and quite existential for the EU, and therefore we managed to find a common ground. Less so on the recent conflict in the Middle East, where the reactions that came were actually muddled. So that's the first challenge. The second challenge is that we must resist the temptation to resort to protectionism. We are an open economy. We require heavily on a well-functioning global economy. Protectionism just isn't going to do it. It will be the consumer who pays the price for this. It is difficult to resist that, and it will become increasingly more difficult. And that is because the global players are using policies that are much more protectionist in nature. And then the next challenge the last challenge is the biggest one, which is the resilience part. How do we actually do all of this? How do we diversify? How do we sustain critical raw materials? How do we produce them and diversify? And last, how do we invest efficiently and effectively, finding the resources to invest and make sure that we do it in the right projects so that we can actually maintain business continuity.
Thank you so much. I think for me there's also a question which we might kind of also be interested in people's perspective on whether we actually have a good understanding of the trade-offs. Do we fully understand the economic implications of some of these policies, at least in aggregate? I mean, I know there is increasing amounts of work to try and understand the impact of fragmentation, but this is something that we haven't really fully experienced historically. We don't really fully know how it's going to play out. And that it makes the trade-off and the judgments around policy a bit more difficult. And of course, a role for us as economists and researchers to do more analysis to deepen our understanding of potential costs as part of the trade-off discussion. Oh, sorry, please.
Can I just add something? I think it's not just that we don't understand the trade-offs. We didn't understand our supply chains.
Yeah.
Right? I mean, so I think that there's a lot of background work that has to be done before we understand the trade-offs, right? So I think we have to be much more informed than we were, and we have to be much more attentive to the business continuity case. So I think there's a lot of work that needs to be done in terms of research before we answer the big questions of trade-offs.
Indeed. So Cornelia, that's, as you're thinking about the implications of this shifting geopolitical landscape for financial stability, from a financial stability perspective in the euro area, how are you approaching it, including given these uncertainties? And I guess how much central banks that are charged with safeguarding stability need to respond in this evolving geopolitical landscape?
Yeah, thanks. So I think the financial sector is affected by these tensions through the real economy mainly, no? The higher uncertainty, the generally worsened economic outlook. You mentioned it all, the supply chains that may break down or simply lead to higher prices. And in Europe, it was a big shock, the Russian war in Ukraine because of our dependency on their gas, of course. I mean, I live in Germany, so we are very, very heavily dependent on that. So we could really feel it, and of course also in our pockets because prices increase, as we all know. And so I think here, these are all elements that can lead to financial instability and thereby also are not conducive to price stability. So we are monitoring this very carefully. And if I think what a central bank can do on the financial stability side to be prepared for this shock, I think, well, we do have a macroprudential framework, no? So that's something that we may have to think about how to employ that more forcefully. I mean, so we have made some progress there in Europe, but for instance, when the pandemic started, we were not very far yet. So I think when the pandemic started, the European banks on average held around 14% capital, and only 0.1% of that was related to macroprudential buffer. So there was not a lot that could be released. No, the idea is that you build this up in good times in order to make banks resilient, and then you may release it in case really there's a shock. So there was not very much to release. So I think that could be an avenue to pursue and to make the system simply more resilient. And actually, over the past 2 years or so, many European authorities have already started to build up these buffers again. I mean, it's a good environment because banks are making profits. They have solid capital positions right now, so it doesn't harm them a lot to keep these buffers. And I must say, side remark, now that banks are making profits, I mean, there are several ways what can happen to these profits. I think paying out dividends excessively is not a good way. Also, taxing is a way, is maybe not a good idea. So from a financial stability perspective, banks should really try to keep some of them as buffers to weather for more difficult times. And I mean, uncertainties have been building up, so I think the case is really strong for that. And I have heard some market participants asking even actually already for a release of these buffers because of the uncertainty, but I think the time for that has not come. That would be more if we really see a materialization of risks. But as I mentioned in my earlier intervention, so far the system is holding up well.
Thanks. And actually, we are one of the countries that had actually built up a countercyclical capital buffer before the pandemic. We released it during it. But then we also rethought of our overall framework and think about how we use this tool, the countercyclical capital buffer, and having there points in time when risks are neither too elevated nor too subdued, precisely because of the uncertainty in judging the environment and the benefits that we saw from having buffers that can be released, so that the banking sector can absorb losses and maintain the provision of services to the economy. So I think this is the overall strategy, macroprudential strategy, in the context of these potentially exogenous shocks, I think is an important question. And maybe, Stephen, to you in terms of geo-economic fragmentation, Ireland, I mean, highly globalized economy, really open. A lot of these, of course, are kind of trends that are driven from outside of Ireland, not really in the control of domestic policymakers. But I guess two questions. So one is, what might the implications for us, for our economy be? And second, what is, from an economic policy perspective, what is the response to this increasing geo-economic fragmentation?
Well, I think one of the things that it's always useful to focus on and get the students in UL to think about this a lot is, you know, we talk about downside risks almost entirely. There are upside risks. An upside risk to increased fragmentation for a small open economy that's highly globalized is that everything just comes here because we're everyone's friend. This is not this. If it sounds a slightly trite point, I'd like to point everybody to 2014 and 2015, when a vast increase in intangible assets simply rocked up on our shores and distorted our GDP statistics to the point that Nobel laureates were mocking us. And this is also the source of much of the increased corporate tax revenue that the state currently enjoys. I think one of the problems with that is, to your point about protectionism, is just being small, being open, and being extremely nimble, which is what this country has to be, means that you're much more alive to any opportunity that arises. And once that's true, then the nature of the change means that you can react to it and do better with it. However, that creates a problem. The problem is that domestically, there is now a new correlation between previously uncorrelated asset classes. All of a sudden, you have to deal with a giant class of asset that you didn't have to deal with before. This is going to result in a needed increased focus on things like supply chains. There's a very small company that we deal with through the immersive software engineering program that I direct. And what they do is they put tags on pallets and beer kegs and things like this. And the owners and the makers of these pallets and beer kegs had no idea where these things were most of the time. Now they know exactly. What is fascinating is, from a very, very simple perspective, these companies have a much, much, much greater view of their supply chain. Now, if that is true for pallets and beer kegs, it is absolutely true for some of the vast increases in rare metals and things like this. We know we need to produce these very, very complicated objects that matter. Is the flight about to leave? If it is, you can go. It's fine. But to make a final point about technology. So finance and technology have always interacted, and I believe there's an upside risk to finance and technology interacting. We've got a vast fintech sector here. There's a very large and vibrant startup sector here. One of the reasons that we need to care so much about innovation is that there is so much of it going on at the moment, and that's a fantastic thing. You know, I want to remind everybody, some of the earliest human writing is accounting and invoices. Right, from 8,000 years ago, it's like Bob needs to pay Jane, you know, this kind of stuff. So I do think that finance and technology have always interacted. They will continue to interact. The difference now is the rate of change. And I don't just mean the first derivative, I mean the second derivative as well. This is something that we need to keep a really, really close eye on, because as we now all know intuitively, when you're in any exponential situation, it matters massively what point of the bend of the curve you're on. And to the extent that you're on an exponentially improving curve, happy days. If you're on an exponentially disimproving curve, that's a big problem. And so that's why really, really good data matters more than ever before. But I would suggest to all colleagues here, because I have this bias built in, when I think of data, I think of numbers in a database. Can I just ask everyone to think carefully about anthropological data that comes from talking to people, deep data, not just big data, deep, really getting into it. It matters massively, and I will point out that the University of Limerick does loads of courses on AI and software engineering and finance and everything else. You cannot do anthropology on the island of Ireland. That's a problem. It's a real problem. And I know Governor Bailey and his colleagues have lots of anthropologists working there. So it's something that we need to work on, because there's no substitute for talking to people in a structured way. Thank you.
Very good. That's actually a really good bridge to our next theme. But before we start talking about the evolution of the financial system, I wonder if we see if there's any questions from people here or from people online, just to make it a bit interactive as well, because that's part of the whole objective of the conference. Just check if there are. Put your hands up, otherwise we can continue. Yeah, please. Oh, there's one there and one there. Yeah. No, one over here.
Maybe I can start.
Yeah, please go ahead. And then we'll get this one. Yeah.
Okay.
We'll collect a couple. Yeah.
Wondering if the central bankers in the room think that perhaps the failure or the slow pace that banks have passed on deposit rates has made their job tougher, and have the central banks had to go higher with the actual level that increases have gone to, and the current pause with both the ECB, the Bank of England and also the Fed, maybe that's okay if the banks start to pass on the higher levels of interest rates and take some of that supply out of the market.
Thanks. There's another one here.
Have we done enough to address shelter? Because we're talking about inflation, we're talking about labour, capacity, output. If we don't have a place to put workforces, and the costs of that in terms of inflation, whether it's profiteering or inflation, they merge, there's elements of both. Have we done enough to address shelter? And in terms of climate and the pandemic, is resilience protecting the financial sector itself when you look at the people in East Cork or everywhere else who probably will not qualify for insurance? Is that resilience? Is that innovation? Are we doing enough? Because those people moved there with good intentions before flooding emerged. And I can't help thinking that the impression is, well, you've moved there, that's you're paddling your own canoe, and you will be for the foreseeable.
Thanks. Is there anyone else? Yeah, one there, yeah.
Thanks very much, Laura Burke of the Environmental Protection Agency, and just to thank you for an interesting morning. Maybe to build on what Stephen Kinsella was talking about, the climate fiscal state, and also the previous question, the focus this morning has really been on Ukraine, Middle East, the interest rates, fragmentation. And I wonder where ESG is in the debate, because although at a European Union level and also at a US level, there's been a focus over the last number of years on ESG, both investment and also reporting. I'm seeing less of that now, and I wonder, is all of the other geopolitical issues causing it to move off the agenda, and the risk of that, and would welcome the views of the panel.
Thanks very much. Why don't we, so I think we have a question about effectively pass-through monetary policy to interest rates and what we make of that from the perspective of inflation, shelter, maybe Stephen on issues around housing here, and then on climate issues, both from the perspective of being on the agenda of policymakers more broadly, but including, of course, central banks. From our perspective, and we can cover that, and also in terms of the provision of services, including potential insurance caps. So who would like to kick off with? And it's Cornelia, would you? Yeah.
Yes, I can take the first question here on the deposit rates. I mean, in this rate hike cycle, deposits have adjusted much with a much lower pace than in previous hiking cycles. So that's really visible. And I think the main reason for that is the excess liquidity that we still have in the system now, that has been given by the central bank. So I think there's just not as much competition between deposit-taking institutions in order to enforce a quicker rise. But what we do see is that depositors are starting to behave differently. So they're moving out of the short-term deposits towards more longer-term investments. And I think there's simply also some sluggishness in the behavior of depositors. That they need some time and also re-education that it's maybe worthwhile investing in government bonds and so on. I mean, we have been in this very, very long, ultra-low rate period for a long time right now. So I think both effects, both the excess liquidity coming down and the depositors adapting, that will solve the problem eventually. It's just that it's taking a little bit more time.
Thanks. Anyone else would like to comment on any of the questions? Yeah, Lisa,
please. I'd just like to add a slightly different perspective. In the U.S., there's been much more movement of deposits, and that's been since March. And some banks are having to rely more on brokered deposits, for example, higher cost funding. And we think that's largely stabilized, but we're keeping our eye on it. I think it's a different situation in the Eurozone, but I think we all have to keep our eye on it.
Thanks very much.
Maybe on the climate, I mean, I need to remind you that of the RRF, the Next Generation EU fund that came into place during the pandemic, was 750 billion that was very much dedicated to green objectives. So, the issue of the energy transition and climate have not been off the agenda, and I don't think they will. There's so much that's been happening at the EU level. Of course, the shocks have a way of diverting our attention. I admit that, but I think on the energy side, the European Union is doing huge amounts and should do even more. When I talked about strategic investments, is exactly what I was talking about. But if you think about the issues like the CBAM or carbon pricing, all of these things are ways of thinking about having the sustainability, the ESG targets very much in the core of the discussion. And I think central banks as well have put the issue in their. Certainly, the ECB that I follow has done a lot to make sure that we are making sure that the financial sector is also ready for meeting some of the financing needs when it comes to the transition. So it's a hope. I don't think we are there, and I hope we'll continue to fight the climate issue.
Thanks, Stephen. Anything from you?
Yeah, just two things. I mean, the first is to the point about have we done enough to address shelter? No. The first meeting I had today was about students that can't find accommodation. Like, these are people who are 17 and 18 years old. They can't find a place to live. So, no, it is going to be seen as not just a market failure, but a policy failure but at a time in the economy when we've never had more money, we are literally inventing new places to put the money, and we don't have enough houses for people. We can't solve the student accommodation problem. It's a massive problem. So no. To Laura Burke's question about the environment, it doesn't matter anymore what we want to do in terms of our focus. Extreme weather events are going to pull our focus into this every single time. There will be another East Cork event. There will be another extreme weather event. The question is, can we put in place a framework, fiscal framework, monetary policy framework, insurance framework, etc., that we can actually, because we know this is coming. This is coming the way Christmas is coming. So we have to be aware of it. ESG and etc. They do matter, but extreme weather will always pull our focus by its very nature.
Thanks very much. So there's actually a few questions from the audience. A lot of them actually link to our third theme, so maybe I'll kind of try and bring them together. So there's a couple of questions on non-bank finance. So one was, I think there were some comments from the UBS chair who thinks the next financial crisis will come from non-bank finance. I think that was in the papers recently. And also there was a question about any comments from the panel on the current thinking on a macroprudential perspective on the non-bank sector. So maybe, Cornelia and Lisa, given that you both mentioned MBFI, first of all, why? What's kind of driving this? What's the rationale behind increased focus from financial stability authorities on the non-bank sector? Clearly, it's a different situation, somewhat between the States and Europe. Capital markets are a lot more developed in the United States than they are in Europe. And then how do we progress that agenda? How do we think about it going forward? Don't know, maybe Cornelia, you want to start?
Yeah, thanks very much. So if you had asked me in January this year where the next financial crisis would come from, I would also have said the non-bank financial sector. But then in March, it was a bit different than the situation. No, I think it's really a good topic. So I'm very worried about what's happening there. I mean, the sector is growing. As Lisa has also said, in many parts of the world, in the euro area, it has roughly doubled, both in terms of the assets that they hold and the financing they provide to the real economy. And generally, that's a good thing. I mean, it provides more diversification for the real sector to get funding. And I think with Capital Market Union advancing step by step, this will even be more. But we have to watch out that the sector remains resilient, because there are spillovers, and the larger it gets, the more interconnected it is with the rest of the financial sector. And there are many types of different vulnerabilities that we should address from the regulatory sphere. And one is to address the liquidity mismatch, then also the leverage that is excessive in certain sectors. You mentioned it before. Yeah, and the interconnectedness. And so many episodes have already happened over the past few years. The LDI crisis last year, there was a failure of the Archegos family office, money market funds were in trouble when the pandemic hit, and so on. So it's really important that we take this up on the international agenda, and I'm very happy that now there seems to be some momentum. I mean, we had the LTCM crisis 25 years ago, and nothing has really happened. But I feel there's now a lot of willingness and momentum there, and there are several work streams under the FSB that look at this, that look at leverage, liquidity mismatch in open-ended funds, liquidity preparedness for the non-banks to be able to face large margin calls in case of that very high uncertainty. So I'm very optimistic that we can make some progress there, but it takes a long time, I think, to come to conclusions. I don't know, Lisa, you want to...
I would just add that an illustration of what can happen in this sector that we don't regulate is what happened in March. Sort of the sell of securities, fast sell of securities, and there could be destabilization in markets that we can't anticipate readily. And there's a lot that we don't know. So I think that we have to try to collect more information, share that information, but I think we have to really keep our eye on this because it's so large. This sector is so large.
Thanks very much, both. I mean, the other question was on central bank digital currencies, and maybe Maria there's the kind of broader question, I think, which is about digitalization and the impact on the financial sector. But maybe you can give us your perspective on central bank digital currencies. I know it also links to our previous conversation about geo-economic risks as well. But there's also a specific question here about how should technology companies that are also stakeholders in this journey engage with the subject with central banks as well?
Okay, so on the CBDCs, and maybe I could link it to the geopolitical elements, because I think there is a great relevance there that we need to sort of accelerate our thinking in. So the first thing to say is that the motivation for creating central bank digital currencies is not the same across the world. Those countries that actually have CBDCs have rushed to introduce them because their motivation was financial inclusion. They wanted to give digital access to financial means to people that didn't have that. The issue of financial inclusion in the euro area is not prevalent. I mean, most of us have access to banks and to digital services on in financial services. So the motivation in Europe is different. Now, is there value added? Yes, there is, for a number of reasons. But I think the most interesting one, and perhaps the one that we are not talking about the most, is the geopolitical things. And it comes actually from the wholesale, in my view. First of all, it needs to be said that on the wholesale side, if we were to have better technology, which is effectively what the CBCs will be doing, the experiments that we have done at the BIS level show us huge gains, both in times and in costs, of international movement of cross-border payments, effectively, cross-currency payments. There will be huge benefits there in the current system. So that's one that we can benefit from. But the second one is the following. When Putin asked European buyers of energy to pay in rubles back at the beginning of the war, the reason why he did that is because all the contracts were in euros. Europeans would pay euros to buy oil from Russia, but then Putin didn't have access to those euros because it had to be settled through the Target 2 system, the settlement system of Europe. So he didn't have access to them. Why am I saying this? I'm saying this because the dollar and the euro are very good currencies in the world, popular currencies, because they're good currencies, but because also they provide, for the biggest part, an infrastructure for settling transactions. Huge transactions are being settled, primarily on the dollar side, which is the dominant currency. If there were to be sanctions, they don't have access to dollars, and they don't have access to, the countries that have been sanctioned don't have dollars and don't have access to the euros. And what's interesting about that, the CBDCs will offer an alternative settlement system if it were to be in operation. This isn't something that will happen tomorrow, primarily because the governance issues of CBDCs at the global level are a difficult problem to solve, the legal framework. But imagine a world in which we are polarizing, and we're talking about geopolitics here, in which countries don't have access to this, don't have access to the global currencies because we are sanctioning them. And the CBDCs are a very good alternative to that. And in fact, you saw immediately the interest on CBDCs went up like this as soon as sanctions were imposed. Countries were saying, well, am I next? And so they need to have an alternative system. And of course, the players that are coming here is China. China is coming in, and where I think we need to do more in, certainly the Eurozone, because we have done a lot of work on what we think about the digital euro, the digital equivalent of our currency. This is the time when the standards are being set. And I think it's absolutely essential, if we want to protect our interests, both the euro area and the US, to actually participate actively in these discussions, but we need to have views on what we want out of that. And in order to get there, we need to develop the CBDC. So this is where I think the big value added will come, not so much on the retail side, particularly because we have payment systems that are very sophisticated in Europe. Do we need one more? But we need to think about the digital currency because of the global element of it, not so much because of internal needs.
Mm. And maybe on because we are running out of time, I think, getting looks. On the theme of digitalization, we mentioned AI earlier. Lisa, you've done some work, and this would be really, I mean, I think we're all thinking about this, what it means for the financial sector, of course, what it means for us. But from your perspective, what are some of the potential interactions with the financial system, some of the risks that we might start thinking about and understanding better going forward? Couldn't not ask about AI, basically. Yeah.
Well, I think that if we just take a step back first, I think that the promise of AI is mainly embedded in its possibly being a general purpose technology. So if it doesn't prove to be a general purpose technology, then we don't have to be so worried. But I think that the advances made in generative AI have certainly advance the notion that this is one, and I think I've, in my recent speech, I gave some evidence that this is becoming a general purpose technology. On the macroeconomic front, I think a big concern is with respect to labor market outcomes, and I am not as pessimistic as some to suggest that it is only displacement that will take place, but I think that these technologies can be labor enhancing, and they could also create demand for labor, and we have to be open to that, as have previous technologies. But I think that with respect to policy, there's a big question with respect to, say, financial applications, financial decisions, any decisions we make within central banks. Andrew is talking about what we do within central banks ourselves. I think that I am very keen to make sure that AI tools are trained on data that are inclusive, broad, and that there's not just a black box mechanism making these decisions. These tools have to be accountable to someone, and we have to understand how the decisions are made, because someone has to be accountable, or something has to be accountable. And certainly, if we allowed this technology, any of us, central banks, we have to be accountable. So we have to watch very carefully how these tools are being deployed.
Very good. Okay, I think we're going to have to wrap up here. Thank you so much to all four of you. Really appreciate it. It's quite a diverse set of topics, and I think it speaks to the fact that we have some near-term challenges that we have to deal with, but then also make the space a little bit the question from the audience to think about the bigger issues, whether it's the climate transition, the technological shift, the big investment that we have to make in our infrastructure, industrial policies. So a lot of us, hopefully that's been a helpful context for the rest of the conference. Thank you so much to all four of you. Really, really enjoyed it. And maybe give a big clap of applause. Thank you. Thanks so much.